You know, it's funny, isn't it? We spend so much time chasing these complicated investment strategies, you know, looking for that secret sauce to like unlock massive wealth,
Right.
when maybe, just maybe, the real key is actually much simpler,
Hmm.
more straightforward. Welcome to the deep dive. So, you sent us The Simple Path to Wealth by J.L. Collins. This is going to be a good one.
Yeah, this book is a classic.
And our mission, as always, is to extract those really valuable insights from the book, the stuff that you, the listeners, can actually use
Absolutely.
to make a real difference in your financial lives. Right now, Collins himself, he kind of jokes about how most financial books are
Yeah,
total snooze fests.
they are. Dry as dust.
Right. So we're going to cut through that dryness and get to the heart of it, the engaging, actionable core of his message.
That's the goal.
Yeah. We're not just summarizing here. We're going deep
Deep dive.
into the philosophy that could really change how you think about money, how you approach your financial future. So get ready.
I'm excited for this one.
Yeah, me too. Because in this deep dive, we're going to unpack the origins of this simple path. We'll talk about the incredible power of consistently saving and investing, and why Collins believes debt is like
Oh, yeah.
the ultimate wealth killer.
Big time.
We'll also delve into his surprisingly straightforward investment strategy using index funds. You know, those workhorses like VTSAX, VBTLX.
I love those.
We'll discuss how to navigate those inevitable market bumps, those scary moments when everyone's hitting the panic button.
The ups and downs, yeah.
Exactly. And we'll explore what it really means to achieve that much talked about FU money.
Yeah, we're talking.
Right. The freedom, the options, that's what it's all about. What's fascinating about this book is how Collins takes these complex financial ideas and makes them so relatable.
He really does. That's one of the things that makes it such a great book. He has this knack for explaining things in a way that just clicks.
Right.
Like, take his analogy of the stock market as a mug of beer.
Oh, I love that one.
Yeah, it's brilliant. Right. The actual businesses are the beer, and the daily price swings are just the foam on top.
The noise.
Exactly. It helps you see what's truly important and what you can safely ignore.
It's such a powerful image. It helps you stay focused on the long game
Exactly.
instead of getting caught up in the day-to-day fluctuations.
The foam.
Okay, so let's dive in. Where did this simple path idea come from for J.L. Collins? What's the backstory there?
So the book actually started as a series of letters that Collins wrote to his teenage daughter.
Oh, wow.
Yeah, he wanted to teach her about money and investing in a way that was clear, simple, and something she'd actually remember.
That's awesome, like a personal finance crash course from Dad.
Exactly. And it's that personal touch that really shines through in the book. You can feel the care and concern in his writing.
That makes sense. It explains the book's direct, no-nonsense tone. So what was that core message about money that he wanted his daughter to really understand?
The fundamental idea is that money can be a powerful tool, something that works for you, not against you, but only if you learn how to manage it properly.
Otherwise.
Otherwise, it'll control you. It'll run your life. You'll be chasing it forever. And that's where his whole philosophy starts, with taking control of your finances.
Right. So taking control, a huge part of that is saving diligently. And that's where this idea of FU money comes in. I love that term. Can you break down what it really means in Collins's framework?
Sure. So FU money, it isn't just about being so wealthy that you can retire early, although that could be a possibility.
Yeah.
It's really about having enough financial security to give you real options in life. The ability to walk away from a job you hate, to take time off without stressing about money, to pursue something you're passionate about without being held back by financial constraints.
It's about having the freedom to make choices.
Exactly. And that freedom, that sense of control, it can have a profound impact on your life. It reduces stress. It empowers you. It allows you to live more authentically. It's about aligning your actions with your values, not just your paycheck.
Yeah. It's about living life on your own terms.
Exactly.
And he shares a personal story, right, from when he was just starting out in his career that really illustrates this.
Oh, yeah. The story about when he was 25 and wanted to travel to Europe.
Tell me about that.
So he'd saved up around $5,000, which is a decent chunk of change back then, and he asked his boss for unpaid leave to go on this trip. A pretty bold move, especially those days.
Yeah, what happened?
Well, his boss initially refused. And Collins, guess what he did? He quit.
Wow, that's taking FU money to the next level.
Right. It shows the power of even a relatively small amount of savings.
Yeah.
It gave him the leverage to walk away from a situation that wasn't serving him.
And it all worked out in the end, right?
It did. His boss actually came back with a compromise, offered him a shorter leave, and Collins ended up getting to go on his trip. But the point is, he had options. He wasn't trapped.
That's so powerful. It's about having that safety net, that ability to say no when you need to.
Exactly. And it highlights the importance of building that financial cushion early on.
Okay, so we've talked about saving and the freedom it can bring. Now let's talk about the flip side. The thing that actively works against building wealth. Debt. And Collins, he doesn't mince words when it comes to debt, does he?
Oh, no, he does not. He calls it a vicious, pernicious destroyer of wealth-building potential.
Just strong words.
Yeah, he's pretty clear about how much he despises debt and how it can sabotage your financial future.
Okay, let's break it down. Why is he so against debt? What are the specific dangers he sees?
Well, first and foremost, debt steals your freedom. It forces you to work just to make those interest payments.
It becomes this constant burden.
Exactly. It limits your choices. It makes it harder to take risks, to pursue your passions, to live life on your terms. It can trap you in a cycle of working just to pay off what you owe.
And that can create so much stress.
It can. It can lead to feelings of shame, guilt, even despair. It can affect your relationships, your health, your overall well-being. It's like this dark cloud hanging over you.
So, for someone listening who might be struggling with debt right now, what advice does Collins offer?
He's a big believer in avoiding debt altogether, but he knows that's not always realistic for everyone. So he lays out some practical steps for getting out of debt. It starts with taking a hard look at your interest rates.
Okay, so walk us through that.
For debts with interest rates below 3%, he says it's okay to pay them off slowly while focusing on building your investments.
Got it.
For rates between 3% and 5%, it's more of a judgment call. You have to weigh the psychological benefits of paying off debt against the potential returns from investing.
Makes sense.
But for any debt with an interest rate above 5%, he's adamant. Attack it aggressively. Make it your top priority.
And he even outlines a specific strategy for tackling debt, right?
Yeah, he calls it the debt snowball method. It's really simple but effective. First, you list all your debts, from smallest to largest. Then, you focus on paying off the smallest debt as quickly as possible while making minimum payments on everything else.
Okay.
Once that first debt is gone, you roll the money you were paying on that debt onto the next smallest debt and so on. It creates this momentum, this sense of progress that can be really motivating.
It's like a snowball gaining speed as it rolls downhill.
Exactly. And as you knock out each debt, you free up more cash flow to attack the next one. It can be really empowering.
That's great. But he also cautions against certain approaches to debt management, right?
Yes, he's very skeptical of debt consolidation services.
No.
He sees them as just another way to make money off people who are already struggling. He also advises against getting too caught up in trying to get the absolute lowest interest rate. The goal is to get out of debt, period.
It's about simplifying, focusing on what matters most.
Right. Don't get bogged down in the details.
Okay, so we've talked about avoiding debt. But what about the common belief that some debt is good debt, like a mortgage on a home?
Collins challenges that conventional wisdom. He argues that a mortgage isn't necessarily good debt. In fact, he advises against buying more house than you absolutely need.
Interesting. Why is that?
Well, he points out that a bigger mortgage means higher monthly payments, which eats into your cash flow and limits your options.
So it's like a form of voluntary debt slavery.
In a way, yes. You're tying yourself to a large financial obligation that can restrict your freedom and flexibility. And he sees the easy availability of mortgages as a major contributor to the problem.
People getting in over their heads.
Exactly. They're tempted by the idea of a bigger, fancier house, but they don't always fully consider the long-term costs.
What about student loans? That's a huge issue for so many people these days.
Yeah, student loans are a tough one.
Yep.
Collins uses his own experience going to college back in the late 60s and early 70s as a point of comparison.
What was it like back then?
Well, he was able to pay for his entire college education. Tuition, books, living expenses, the whole shebang, with the money he earned from his summer job.
Wow. Hard to imagine that today.
Right. He points out that college costs has skyrocketed since then, far outpacing inflation. And he argues that the easy availability of student loans has actually contributed to this problem.
How so?
Well, when there's a lot of money sloshing around, colleges have less incentive to keep costs down.
Makes sense.
So the tuition goes up, administrative costs go up, and students are left with mountains of debt.
It's a vicious cycle.
It is, and it puts a huge financial burden on young people, just as they're starting out in life.
So we've talked about the importance of avoiding debt and saving diligently. But what about investing? How does Collins recommend we put our money to work?
This is where the simple path to wealth really shines. He advocates for a surprisingly straightforward approach. It all boils down to three basic tools: stocks, bonds, and cash.
Okay, let's break those down. Starting with stocks.
For stocks, his go-to recommendation is VTSAX, which is Vanguard's Total Stock Market Index Fund.
Classic.
It is. This fund gives you exposure to pretty much every publicly traded company in the U.S., which means you're instantly diversified.
Diversification is key, right?
Absolutely. You don't want to put all your eggs in one basket. And Collins sees stocks as the engine for long-term growth. Over time, they've consistently outperformed other asset classes.
But they can be volatile, right?
Yes, in the short term, stocks can go up and down a lot. But over the long haul, they've historically trended upwards.
Got it. So what about bonds? What role do they play in his strategy?
Bonds are like the steady eddy of the investment world. They tend to be less volatile than stocks, and they provide a source of income. Collins recommends VBTLX, which is Vanguard's Total Bond Market Index Fund.
Yeah, okay, so another index fund.
Yep. He likes index funds because they're low cost and easy to manage. You don't need to be a financial expert to invest in them.
And the third piece of the puzzle is cash.
Right. Cash is important for your short-term needs and emergencies. It's the money you keep readily accessible in a checking or savings account.
It's your financial cushion.
Exactly. And Collins emphasizes the importance of having enough cash on hand to cover your living expenses for several months in case of an unexpected job loss or other financial setback.
Now, one thing I've always wondered is why Collins is such a big fan of index funds. Why not try to pick individual stocks or invest in actively managed mutual funds?
Well, he's actually quite skeptical of active investing. He argues that it's very difficult to consistently beat the market, even for professional investors.
So trying to pick winners and losers is basically a fool's errand.
Pretty much. He points to the fact that most actively managed funds actually underperform the market over the long term once you factor in their fees.
So you're better off just going with the broad market.
That's his view. He likes to use the analogy of the stock market as a casino.
Interesting.
He says that short-term trading is like gambling. You're betting on which way the market will move, and the odds are stacked against you.
So the key is to ignore the noise and focus on the long game.
Exactly. It's about owning a piece of the overall economy and letting it grow over time.
Now, market volatility is something that scares a lot of people. How does Collins advise us to handle those inevitable ups and downs, what he calls the big ugly event?
Well, he acknowledges that market crashes can be scary, but he stresses that they're a normal part of the market cycle.
They've happened before, they'll happen again.
Right. And historically, the market has always recovered from these downturns. He points to the fact that the Dow Jones Industrial Average has gone from 66 in 1900 to over 30,000 today, despite 2 world wars, a Great Depression, and countless other crises.
So the message is, don't panic.
Exactly. Don't sell everything when the market takes a dip. In fact, he sees those dips as buying opportunities.
Buy low, sell high.
Exactly. When the market is down, you can buy more shares at a lower price. It's like getting stocks on sale.
So the key is to stay calm and stick to your long-term plan.
Right. Don't let your emotions dictate your investment decisions.
He also talks about different portfolio strategies depending on your stage of life, right?
Yeah, he outlines 2 main approaches: a wealth accumulation portfolio and a wealth preservation portfolio.
Can you explain those?
Sure. The wealth accumulation portfolio is for people who are still in the saving and investing phase of their lives. They're focused on growing their wealth over the long term.
So younger people, basically.
Yes, typically. And for this group, Collins recommends a very simple portfolio: 100% stocks. Specifically, VTSAX.
All in on stocks?
Yep. He argues that younger investors have a long time horizon, so they can afford to take on more risk. And historically, stocks have provided the highest returns over the long run.
But that seems pretty aggressive.
It is.
Yeah.
But Collins believes it's the best way to maximize growth potential. Of course, it's important to assess your own risk tolerance and make sure you're comfortable with this level of volatility.
Okay, and what about the wealth preservation portfolio?
That's for people who are closer to retirement or already retired. They're no longer focused on growing their wealth. We're focused on preserving it and generating income.
So they need a more conservative approach.
Exactly. For this group, Collins recommends a mix of stocks and bonds. The exact ratio will depend on your individual circumstances, but a common starting point is 60% stocks and 40% bonds.
Okay, so a more balanced approach.
Right. It's about finding that sweet spot between growth and stability.
Now, what about tax-advantaged retirement accounts? He mentions those as well, if I recall.
He does. He's a big advocate for utilizing tax-advantaged accounts like 401k, IRAs, and HSAs.
Can you give us a quick rundown of those?
Sure. So a 401k is a retirement savings plan offered by many employers. You contribute pre-tax dollars, which lowers your taxable income, and your investments grow tax-deferred until retirement.
So you save money on taxes now and later.
Exactly. An IRA, or individual retirement account, is similar, but it's not tied to an employer. You can open an IRA on your own, and there are two main types, traditional and Roth.
What's the difference?
With a traditional IRA, you contribute pre-tax dollars, just like a 401k. But with a Roth IRA, you contribute after-tax dollars, and your withdrawals in retirement are tax-free.
So you pay taxes now, but not later.
Right. And finally, an HSA, or health savings account, is a special type of account that can be used to pay for medical expenses. It also offers tax advantages, so it's a great option if you're eligible.
Got it. So College is a big fan of Vanguard. What is it about Vanguard that he likes so much?
Well, for one thing, Vanguard is known for its low fees. That's a big deal because fees can eat into your returns over time.
Death by a thousand cuts.
Exactly. But more importantly, Collins appreciates Vanguard's unique ownership structure. Vanguard is owned by its fund investors, which means their interests are aligned.
That's different from most other investment companies.
It is. Most other companies are publicly traded or privately owned, which means they have to answer to shareholders. And sometimes those shareholder interests conflict with the interests of the fund investors.
So Vanguard is more focused on serving its customers.
That's the idea. And Collins believes that makes a big difference in terms of their investment philosophy and their commitment to low costs.
He also has an interesting take on dollar cost averaging, or DCA. Can you explain his perspective on that?
Yeah. DCA is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. It's often touted as a way to reduce risk and take the emotion out of investing.
Yeah, I've heard that before.
But Collins is actually skeptical of DCA. He argues that it can lead to lower returns over the long run, especially if the market is trending upwards.
Why is that?
Because when you're dollar cost averaging, you're essentially betting that the market will go down so you can buy more shares at a lower price.
I never thought of it that way.
But historically, the market has gone up more often than it's gone down. So if you're consistently investing a fixed amount, you're likely to miss out on some of those gains.
So he's more in favor of lump sum investing.
Generally, yes. He believes that if you have a lump sum of money to invest, you're better off putting it to work in the market as soon as possible.
Makes sense. But he also acknowledges that DCA can be a good option for some people, right?
Yeah, if you're just starting out and don't have a lot of money to invest, DCA can be a good way to ease into the market. It can also help you overcome the fear of investing all at once.
Okay, so it's not a one-size-fits-all approach.
Exactly. The best strategy for you will depend on your individual circumstances.
One of the things I really appreciate about The Simple Path to Wealth is that Collins doesn't shy away from talking about the dangers of financial scams and bad advice. What are some of his key warnings in this area?
He's very clear that anyone can be conned, regardless of how smart or savvy they think they are. And he warns against the prevalence of bad advice in the financial services industry.
It's like a minefield out there.
It can be. There are a lot of people who are more interested in lining their own pockets than helping you achieve your financial goals. Collins stresses the importance of being skeptical, doing your own research, and never blindly trusting anyone with your money.
It's about taking ownership of your financial future.
Exactly. Don't rely on others to do what's best for you. Be informed and empowered to make your own decisions.
He also touches on the topic of retirement income, specifically the 4% rule. Can you explain that?
Sure. The 4% rule is a guideline for how much money you can safely withdraw from your retirement portfolio each year without running out of money.
So it's a way to make your savings last.
Exactly. The basic idea is that you withdraw 4% of your portfolio's value in the first year of retirement and then adjust that amount for inflation each year.
And that should, in theory, allow you to maintain your lifestyle throughout retirement?
In theory, yes. But it's important to remember that the 4% rule is just a guideline. It's not a guarantee.
There are a lot of factors that can affect how long your money lasts in retirement.
Right. Your investment returns, inflation, your health, your longevity, all of these things can play a role. So it's important to be flexible and adjust your spending as needed.
What about Social Security? Does Collins factor that into his retirement planning?
He does, but he encourages readers to approach Social Security with a healthy dose of skepticism. He acknowledges that it's an important source of income for many retirees, but he also points out that it's facing some serious challenges.
Like what?
Well, the Social Security system is basically a pay-as-you-go system. That means that the taxes paid by current workers are used to pay benefits to current retirees.
Okay.
But the problem is that we have an aging population, and there are fewer workers coming into the system to support all those retirees.
So it's a demographic time bomb.
In a way, yes. And that means that Social Security benefits may be reduced in the future. So Collins advises readers to plan their retirement as if Social Security won't be there.
That's a very conservative approach.
It is, but it's also a realistic one, given the uncertainty surrounding the program's future.
He also briefly discusses the concept of giving back through charitable foundations, even for those who aren't ultra-wealthy.
Yes, he shares his own experience with setting up a charitable foundation through Vanguard. He found it to be a relatively simple and straightforward process, and he highlights the tax benefits and the control it gives you over your giving.
So you can make a real impact with your money.
Exactly. And you don't need to be a billionaire to do it. There are options available for people at all income levels.
As the simple path to wealth comes to a close, what are some of those key takeaways, those nuggets of wisdom that Collins leaves the reader with?
He summarizes his philosophy into a few core principles. Avoid debt, live below your means, save and invest consistently, and focus on the long term.
It sounds simple, but it's powerful.
It is. And he emphasizes that these principles are universal. They apply to everyone, regardless of their age, income, or background.
It's about taking control of your financial destiny.
Exactly. And he reminds readers that the ultimate goal isn't to accumulate a massive fortune, but to achieve financial independence.
That freedom to live life on your own terms.
Right. It's about having the choices and the options that money can provide. It's about being able to pursue your passions, spend time with loved ones, and make a difference in the world.
So, as we wrap up this deep dive into the simple path to wealth, a few key insights really stand out. The importance of saving consistently, investing in low-cost index funds, and avoiding debt like the plague, and ultimately remembering that financial freedom is about so much more than just money. It's about having choices, having options, and living a life that aligns with your values.
Couldn't have said it better myself. And if this deep dive has sparked your interest, I highly recommend checking out the book, The Simple Path to Wealth by J.L. Collins. It's a must-read for anyone who wants to take control of their financial future.
Now, as you reflect on what we've discussed today, I have a question for you. What's one small step you can take right now to move closer to your own financial goals? Thanks for joining us on this deep dive.